All right, welcome back to the channel, Bull Runners. So in this video, we have to discuss what the Federal Reserve just did that destroyed 99% of millennials that are looking to buy a home and will cause one of the biggest crypto bull runs in history on the opposite side of the scale that will allow just 1% of the smart millennials, the smart baby boomers, the smart people out there who subscribe to this channel to become the first millionaire in their family. So guys, buckle up, okay? Because today's video is going to be a powerful one. In today's episode of interest rates, and subscribe to the channel if you want to defund Bill Gates. First, let's talk about interest rates, okay? You see the Federal Reserve, which is the central bank in the United States, you know, they're not a central bank basically, and they don't hold any reserves. They've been hinting that interest rates will stay higher for longer. So if you watched my video from the other day talking about what Jerome Powell just said about the Fed pausing on their rate hikes, but having plans to raise one more time this year, this is a big deal. And in this video, I'm going to explain why this matters for all of us cryptocurrency degenerates out there. So like this video if you want to see more updates like this. So the crypto market often dances to the beat of traditional finance, but instead of a smooth ballroom dance that you see those Latinos do, you know, us white people, I don't know how to dance, okay? I just kind of bob and weave a little bit, but this dance in the crypto space, it's more like a drunk frat party dance, you know, where everyone enjoys the night, they go crazy, but they dread the hangover that's coming in the morning. And so the hangover that's coming to the economy is on the horizon, and it will happen, but everyone wonders when will it happen and what will that look like for the stock market, for the crypto market, and for the real estate market. So with the Fed saying that rates will remain high for an extended period of time or even go higher, it affects crypto along with everything in the economy. And this is a big deal for you to understand, and here's why, okay? The Federal Reserve funds rate is the rate that determines how expensive a mortgage will be when you're thinking about buying a home, and is one of the most important factors that affects the crypto market, because when the rates go higher, it's more expensive to take out loans, and when less people are taking out loans, there's less liquidity sloshing around in the system. But it's not the only driver of market behavior, because a lot of people say that when the Fed's rates go up, well, the crypto market goes down. In the short term, yes, but I think that's been proven otherwise, because even with the Fed raising rates, the crypto market has seen a relief rally. So the massive increase in the US debt is the other balloon on the radar that we need to be aware of, because it's projected to reach over $50 trillion by 2033 and will have massive consequences for, you know, everyone's day-to-day life. But there will be some pros as well too. And one of the pros that this will have for the crypto market is the increase in gross debt could inject a substantial amount of liquidity into the financial markets and into the crypto market. And in response to liquidity injections, investors, what they would do is they would seek assets that offer higher returns than traditional fixed income investments, you know, such as you see like stocks and cryptocurrencies. So that brings up massive inflation concerns, which is what the Fed is trying to fight right now by raising their effective federal funds rate. So the Treasury and the Fed just keep stepping on each other's toes, trying to do this, you know, smooth ballroom dance. But that brings up massive inflation concerns for what's about to happen, because according to the Kobasi letter, it's been over 60 hours since the U.S. debt crossed $33 trillion, and it's already up another $50 billion. So this means that we've added $833 million in debt per hour since the U.S. debt crossed $33 trillion. So in the total U.S. debt, if it was divided by every single household in the country, each household would get about $252,000. Now, that's enough to change anyone's lives, obviously, but the Treasury is officially paying more than $2 billion per day in interest expenses on the bonds that they are issuing. $2 billion per day. And so, in order to pay that interest, you know, all while the debt ceiling bill, you know, leaves the debt limit uncapped until January of 2025, they're going to keep going up on that. So this is going to end in a financial disaster, passing on those expenses to pay the interest payments on those bonds to the consumers like you and like me through, higher taxes, higher goods and services in the grocery store. And so the financial disaster that's coming, the crash that's coming, I'm going to explain what that's going to look like. So with the gross debt expected to go up, the money supply is expected to increase as well too. And if there's too much money in the system sloshing around, chasing too few of goods and services, well then demand is going to outstrip supply and prices will tend to rise, leading to more inflation. So the Fed is trapped right now with what the Treasury is doing. And this means that as interest rates go up to fight inflation, while the gross debt rises, bringing inflation up even more, then the cost of living skyrockets, taxes increase, and the value of the dollar will keep plummeting. So this is why assets like crypto, precious metals, real estate are being used as a hedge against inflation, because it's a fact that the Treasury and the Fed are destroying the spending power of the dollar through their actions. However, it's important to note that the relationship between debt, interest rates, and market behavior is very, very complex. It's not an easy answer for this. So hang all the way to the end of this video and you'll have a better understanding of how all of this will affect the crypto market and what you can do to prepare. So while an increase in gross debt affects inflation, driving money into stocks, into cryptocurrencies, and away from the dollar, the Fed fights this by raising the effective federal funds rate and tightening its balance sheet to bring inflation down. And so, the Fed is the firefighter in the arson, as we hear, police sirens and firefighters, driving down the street right now. So they create the problem, and then they try and put the problem out and present a solution and try and claim to be the saviors when they created the problem in the first place. But then they blame the problem on Ukraine or on Putin or on Russia or on something else other than themselves, because if they were to take accountability for their mistakes, well then they wouldn't get reelected. So when the Federal Reserve tightens its balance sheet, it typically means that the Fed is reducing its holdings of assets, including Treasury bonds. This process is often referred to as balance sheet normalization, or QT, quantitative tightening, versus quantitative easing, where they're printing money. Quantitative tightening is pretty self-explanatory. They're tightening down. And so when the Fed tightens its balance sheet, investors get less risk adverse, and they pull money out of riskier assets like crypto and put them into government bonds that the Fed is selling because they offer higher percentage returns and less risk. And that's, if you think about this for a second, it's preluding it. So investors prepare for the Fed's next move. That's why the market started crashing while they were doing this. People didn't wait until it was done. And so what's about to happen next, when you look right now at the top 5 stocks, now reflecting 24% of the entire S&P 500's market cap, that's only from 5 stocks, 24%. That's crazy. So this is the same exact level seen in 2020 prior to the pandemic-related crash. Now, to compare this back to 2008, the top 5 companies reflected just 14% of the S&P 500's market cap. In the year 2000, for the dot-com bubble boom, which is widely considered one of the largest bubbles of all time, the top 5 stocks reflected only 19% of the S&P 500. So the S&P 500 market is being held up by just a few big names, and it's being held up in terms of a higher percentage than it was for the last crashes of 2000 and 2008. Now, if you take out the top 7 performing stocks in the S&P 500, it is up less than 5% this year. And if you were to compare that to the 2-year Treasury yield sitting above 5%, investors are going to get cooked if they don't understand this. Okay, you're going to get deep fried, deep dish, and it's not going to taste too good. Even though that might sound pretty delicious, trust me, it isn't. If the Fed is selling Treasury bonds to tighten their balance sheet and the Treasury is issuing more Treasury bonds for the, okay, listen to this. I know it's hard to pay attention right now because this can seem complicated, but if the Fed is selling Treasury bonds to tighten their balance sheet and the Treasury is issuing more Treasury bonds for the gross debt to go from 33 trillion to over 50 trillion by 2033, then who do you think would buy those Treasury bonds long term if the Fed keeps selling them to tighten their balance sheet? So eventually something has to give. Private investors such as like people like you and me, mutual funds, banks, foreign governments are the primary buyers of treasury bonds, and also they're the ones who have to eat the consequence of this. And so as the US dollar goes down and, as the US suffers, other countries can suffer even more, and the consumers of these countries suffer the most because the rich get richer, the poor get poorer, and the elite run off with the bag. So when the Fed sells treasury bonds, investors purchase them if they find the yields and the terms attractive. And because the yields of short-term 2-year bonds are around 5.09% versus the 10-year yield at about 4.49% at the time of shooting this video, investors will be buying more short-term bonds in the near term, expecting an economic recession or meltdown within the next 2 years because the yields on the short-term bonds are more attractive than the yields on the long-term bonds. So the situation where short-term bond yields are higher than long-term bond yields is referred to as what's called the inverted yield curve. And it can have several underlying reasons for this and also consequences as well too. So let's talk about them, okay? So one of the most common reasons for an inverted yield curve is market expectations of an economic downturn in the short term due to what the Fed and the Treasury are doing. And so when we see the curve invert, the market's reacting and preparing for a crash. And that crash, though, may be delayed until additional factors align to validate those concerns, leading to a much larger disaster on the horizon when the curve goes back into the positive, making the 2022, bear market look like the pregame for the much bigger crash that's on the horizon. And when investors anticipate weaker economic conditions in the near future, they seek the safety of longer-term bonds, driving up their prices and pushing down the yields of the long-term bonds. So, the 10-year yields, yes, they're lower than the 2-year, but the prices are higher because investors have ran to those. And conversely, they may be less inclined to tie up their money in shorter-term bonds, leading to higher yields on short-term bonds and causing this inverted yield curve inversion. And so that's what's happening. When the yield curve inversion flips back into the positive, meaning what this means is that short-term bond yields drop below long-term bond yields, it's often known as like normal or a positive yield curve versus inverted, right? So it's typically indicating a change in investor sentiment and economic expectations as investors sell their long-term bonds to buy short-term bonds fueled by the Federal Reserve leading those purchases. So when the Fed makes this pivot, the timing between an inverted yield curve and the onset of a recession, it varies, so it's not precise science here. It is impossible to predict with 100% accuracy, but it is possible to predict that it will happen because it's not a matter of if, it's just a matter of when. And the key for you to be ready, because you don't need to know when it'll happen, you just need to know that it will happen and what to do before it happens and how to prepare. Because historically, there's been a reasonable correlation between an inverted yield curve and subsequent recessions and economic downturns and market crashes. So here's a general pattern based on what's called lead time that you have to be aware of. So an inverted yield curve is typically seen as a leading indicator, meaning it's often precedes an economic recession. So it can signal that market participants are expecting weaker economic conditions in the future. It is absolutely going crazy out here right now. I feel like today's one of those days where I make a video and just every noise possible is happening out here. So what this is signaling, guys, is chaos is about to ensue. Panic's coming. You better be ready to back up the truck. And so market participants and investors, other countries and central banks are expecting weaker economic conditions in the future. So some people are even saying that we're in a recession right now, and this impending recession is already happening because they can simply just change the definition of what a recession is, and that's exactly what they've done before. Just like they want to say inflation is transitory, so they just say stuff that isn't true to keep. What they're doing is they're keeping the villagers from panicking. If you give people bread in a circus, it stops them from revolting. During the Roman times, the collapse of the Roman Empire, what they did is they would pack people into the Colosseums and they would give them shows of fighting, and they would give them bread, and they would give them wine, keep them drunk, merry, and feeling fine, and that will stop them from focusing on what's wrong and rioting in the streets. Because if people were to put themselves together, they could overthrow the government just like that. But people are scared, and they're fearful of what could happen to them. Like, hey, if you storm the Capitol, you're going to get thrown in jail. So people will just sit in their house, they'll consume their Netflix TV shows, and they'll, consume the food that they're given, and watch their shows and not say anything about it. But you're watching this video, you're subscribing to the channel to stay informed, because in the past, recessions have often followed an inverted yield curve with a lead time ranging from several months to a couple of years. So the exact lead time varies from one instance to another, and I'll share with you when I feel this is going to happen. So there's no fixed rule, for how soon after a yield curve inversion a recession will occur, because it depends on a range of factors, including, economic conditions, policy responses, what they do next, and external events. So it's not a matter of if, it's just a matter of when. So the time to prepare is now, and I'll explain what I'm doing by the end of this video. So hang tight, because the timing of a recession can be influenced by various economic dynamics. When you see consumer and business spending habits change, supply chain disruption, trade conditions, fiscal policies, central bank actions, it's a lot to focus on. It's a lot to learn about. And in order to understand everything, when you educate yourself on a consistent basis and you watch videos like these, you'll gain new insights and new aha moments that will expand your financial education. So, these factors, what's about to happen is either going to hasten or delay the recession. And, Jerome Powell is saying that they're not expecting a recession until 2027, but that could all be a distraction for what's going on right now. And the actions taken by the central bank and governments is going to play a role in the timing of this. And what they're doing to delay the recession will completely destroy the dollar, which in turn will make the crash much worse the longer that they put it off, if they're trying to usher in a smooth landing rather than a hard landing. So it's like the inflation is just a balloon that they just keep blowing up to the point of no return. And recessions can also be triggered, and accelerated by global events like financial crises, geopolitical conflicts, wars, natural disasters, which could be the metaphorical thumbtack to pop the balloon that's coming. And with the devastating, wildfires in Maui, Canada, Brazil, and tons of other places around the world being blamed on what? Global warming. Anyone with eyes can see what's really going on here, guys. For them, they want to usher in the Green New Deal to create smart cities, universal basic income, and it's all connected to their New World Order and central banking digital currencies, where they can control, how much, when, what, and where, and when, at what times you spend your money, giving them complete control and total control over what you do. This is what the Bank for International Settlements said. They said they will have complete and total control and the technology to usher in that control. So it will be a big problem, but at the same time, it's going to provide a lot of opportunity, because when crashes take place, when this type of stuff take place, when these pivotal precipice moments happen, those that are ready become wealthy. That's why if you're going to become the first millionaire in your family tree, you're subscribing to the channel and you're liking videos like these. So they create the problem and then they give you the solution. So you're forced to trust them. So they seem like the white knight and the savior. So here's what to watch out for, okay? When the central bank, aka the Federal Reserve in the USA, cuts short-term interest rates aggressively in response to economic challenges or a recession or some catastrophe, if they break something, when they break something, and then they start cutting rates to combat the problem in the fire that they created, what it's going to lead to is lower short-term bond yields and higher long-term bond yields. So this will create a positive yield curve inversion going in the opposite direction, and it'll reverse it from where we are right now, which is a negative yield curve inversion. But this will only happen after or during a recession or economic disaster in response to this. So the Fed responds to the problems they create, meaning the Fed is steering this boat with the wake, which always lands the boat on the rocks. That's why you do not want to wait for this to happen, because when it does, it's going to be too late and your portfolio will get absolutely destroyed. So by the time the markets are crashing and the yield curve is flipping back into the positive, investors, what are they going to be doing? Well, they're going to be freaking out. It's going to be mass panic. People are going to be pulling their money out of the markets, creating a domino effect of mass liquidations. But eventually what will happen, though, is when the dust settles, investors, they're going to calm down, and people, smart money that has money on the sidelines, they're going to start funneling money back into the stock market, back into the crypto market. And then the Fed will start quantitative easing again. But inflation will come rearing its ugly head yet again. And everything will become more expensive. So it's better, right? This is what people are realizing. It's better to hold assets like crypto, precious metals, and real estate long-term, regardless of short-term volatility and short-term crashes, than it is to hold dollars that lose 5 to 10% in spending power per year in an inflated economy. So even though the crypto market is more volatile, history has shown over the past decade plus that it drastically outperforms the dollar, whereas the dollar is like a scab on your arm that just keeps bleeding, that the Fed can never heal up no matter what they do. And so people that aren't investors, that are savers, that's why the saying savers are losers is one of the most true sayings of all time. Because investors believe, what they believed is that when inflation was climbing up to 10%, they believe, that as it approached 10%, well, they started to accept that lower yields on long-term bonds as a hedge against future low inflation rates or interest rates and inflation. So they were preparing for the drop in inflation. And because the inverted yield curve is often viewed as a potential warning sign of an impending economic recession, investors are expecting a crash to happen next and expecting inflation to go back up, expecting unemployment to spike back up like what happened in 2008, like what happened in 2000, like what happened in 2020. It's going to happen again because Biden is bragging about record low unemployment. That's not a good thing, guys. Dumb people watch that and they're like, yeah, that's good. That's good that's happened. That's not a good thing. Unemployment needs to be higher. It's around 3% right now. So when that spikes up, it's not going to be good. So historically, inverted yield curves have preceded economic downturns, okay? Inverted yield curves have preceded economic downturns. However, it's not a foolproof indicator, obviously, and other economic and market factors you got to consider and take into effect when assessing your investing strategy. So don't take this as financial advice. The decision for the Fed to tighten the balance sheet and sell short-term treasury bonds is why the short-term yield is higher than the long-term yield as they offload that debt, is the reason why the markets crashed in 2022. Eventually, something is going to break, and it will most likely be what's going to happen in the banks. There will be another bank run, and you have to be ready. And so when I expect this to happen, when do I expect this to happen? Well, right now, money has been coming into the crypto market. And money will continue to flow into the crypto market, I believe, until the end of 2025. And if you look at the community section on YouTube here, on the Bull Runners channel, you'll see a chart that dates all the way back to 1875, and it shows, historical booms, busts, and, great times, prosperous times, crises, and good times to sell and good times to buy. And it shows that based on, what a farmer put out there. So you can check that out. I think you guys will love it. But either way, at the end of 2025, I expect the crash to come 2026. So they're going to do whatever they can to delay it, but it's going to make it that much worse. And 2026, I think, is going to be an absolute disaster. Okay? But up until then, I think it's going to be amazing for crypto. So that's why it's imperative and it's important to focus on creating passive income. So here's 3 things that I'm doing to prepare before this happens. And I'm operating as if it's going to happen tomorrow. That's how you have to operate. That's the most important thought process, is move with a sense of urgency, okay? This is serious. I know I like to crack jokes here and there, but this is very, very serious. And so what you choose to do is up to you. As always, do your own research. It's not financial advice. This is for educational purposes only. What I choose to do should not determine what you choose to do. This should just point you in a direction where you can research it yourself. So number 1, what I'm doing is I'm backing up the truck for gold, for silver, for crypto, to prepare for the liquidity injections from the institutions when the spot Bitcoin ETFs get approved, specifically in the crypto market. Central banks, I pay attention to central banks. They're buying gold. So that's why I'm bullish on gold. Because if central banks are doing it, what does that mean? They're running away from the devaluation of the dollar, because it's a fact that the dollar is declining. So number 2, what I'm also doing is building out a community for everyone to stay informed and connected through bullrunners.com and through this YouTube channel, because the more that we can stay connected, the better informed that you can be and the better prepared you can be. So it's free to join. All you have to do is, go to bullrunners.com, enter in your name, put in your best email address and your best phone number to join our community and get daily updates like this to educate yourself on what's going on in the world of finance and crypto. As always, make sure you subscribe to the channel so you can get notified right away when the algorithm pushes it to you. But when you go to bullrunners.com, you'll be notified first of any new updates, any new launches, any new things that we're doing to help you guys prepare. And number 3, what I'm doing is I'm educating myself daily, because in order to earn, first you have to learn. Then you remove the L, and that's how you earn. So L, you never take a loss. It's always a learning lesson. Even if you lose money, even if a project doesn't work out, even if Bitcoin, XRP, Ethereum, even if the whole crypto market goes away, you're always learning. You're taking those lessons to move forward in the future. And so you never let one strikeout hold you back from a home run. So most people, what they do, and the reason why they fail, is they stop learning after high school or college, and then they go and they plug right into the matrix, which doesn't teach them anything other than get a job with a good pension, work Monday through Friday for 40 years to, pay your bills, pay for a home, invest in a 401k, and maybe retire with enough money to survive for a few years, but you're not truly living. Now, I'm not bashing jobs. I'm preaching the truth here, because the matrix was created so the elite who created it don't have to defend it when anyone attests it, okay? The matrix was created so the people defend it, so the elite don't have to when anyone attests it. If you watch Neo, or if you watch The Matrix, when he walks around, the agents defend it. And the agents are people that, are so brainwashed by the system that they don't understand what they're even trapped within. And so still work your job, keep your job in the matrix to pay your bills, but invest on the side, build something on the side, because the days of the 40-40-40 plan, work 40 hours a week for 40 years of your life to retire on 40% of your income, those days are done. Pensions are being looted. 401ks are going to be destroyed, and the future is blockchain technology. So what we are doing is we're backing up our trucks all the way to the bank, grabbing the bags, packing them and stacking them, leaving no bags left behind, because the spending power of the dollar continues to go down in value. That's a fact. Based on inflation, cryptocurrencies, blockchain technology is going up in interest. That's the truth. And together, we're all going camping on the beaches of the moon. I will see you on the next video. I will see you on bullrunners.com. As always, you know what to do. Stay bullish.